The upcoming speech by Federal Reserve Chair Jerome Powell at the Jackson Hole Conference could leave Wall Street feeling quite let down. Scheduled for Friday, this event has historically been a platform for central bank leaders to hint at future interest rate changes. Last year, Powell hinted at a shift towards rate cuts, stating, "The time has come for policy to adjust," and expressing increased confidence that inflation was on a sustainable path back to the 2% target. Currently, many on Wall Street are anticipating that the Fed will initiate rate cuts in September, especially after a prolonged period of holding rates steady amidst the economic impacts of President Donald Trump's tariffs. The administration has been vocally urging the Fed to ease monetary policy, particularly following the appointment of a more dovish member to the Board of Governors. However, this year, Powell might not provide the clear signals that investors are hoping for. Some analysts are skeptical about the likelihood of a rate cut in September, given that inflation is still above the Fed's target and is showing signs of increasing due to the pressures from tariffs. The economic conversation is also shifting, with economists debating whether the recent decline in job data is a result of weak demand for labor or a shortage of available workers. If the issue lies with supply, then cutting rates could exacerbate inflation rather than alleviate it. Michael Pierce, the deputy chief U.S. economist at Oxford Economics, noted that the effects of tariffs are unevenly impacting prices and are likely to continue pushing inflation higher in the coming months. He believes it will be challenging for policymakers to distinguish between temporary tariff impacts and more persistent inflationary trends. Pierce currently predicts that the Fed will maintain its position until December, although a disappointing jobs report for August could alter his outlook. Veteran market analyst Ed Yardeni has maintained a cautious stance, suggesting that the Fed will refrain from cutting rates this year due to ongoing inflation concerns and the resilience of the U.S. economy. Regarding Powell's upcoming address, a note from Citi Research indicated that he is likely to adopt a wait-and-see approach rather than taking a definitive stance as either a hawk or a dove. The note suggested that Powell might acknowledge the possibility of a rate cut in September, but emphasize that any decisions will be based on incoming data. Bank of America has echoed this skepticism about imminent rate cuts, highlighting that Powell previously indicated he would be comfortable with modest job growth as long as the unemployment rate remains stable. This scenario appears to be unfolding, and BofA believes Powell's speech will provide him with an opportunity to align his statements with current data. If Powell aims to discourage a September cut, he might assert that the current policy stance is appropriate based on available data. This phrasing would allow him to retain the option of cutting rates if the August jobs report is particularly weak. Conversely, he could signal a potential cut by suggesting a shift towards a less restrictive policy stance. Wall Street has largely factored in a rate cut for September, so any indication that investors may need to wait longer could be a significant disappointment, akin to a rate hike in its impact. Preston Caldwell, chief U.S. economist at Morningstar, pointed out that given the market's long-standing expectations for a reduction, delaying cuts further would effectively tighten monetary policy at this juncture. Interestingly, even among those economists who believe the Fed will cut rates next month, there is skepticism about whether Powell will reveal his intentions during his speech. JPMorgan noted that the Fed's dual mandate of controlling inflation while maximizing employment currently leans towards prioritizing employment. Despite recent inflation data suggesting that tariffs are influencing prices, a lackluster jobs report should push the Fed towards considering rate cuts next month. However, with several Fed officials recently stating that the case for a rate cut has not yet been established, and with more employment data on the horizon, JPMorgan believes Powell will not be able to firmly indicate a move towards easing at the upcoming meeting. Citi Research's chief U.S. economist Andrew Hollenhorst, anticipates that Powell will provide a hint towards a potential cut, but will stop short of making any firm commitments. This hint might come in the form of a statement indicating that the risks to employment and inflation are beginning to balance out. In July, Powell mentioned that if these risks were balanced, then interest rates should be more neutral. Given that he described the current rate level as modestly restrictive, this suggests that balanced risks could warrant a rate cut. Since then, job data has indicated a softening labor market, allowing Powell to assert that risks are becoming more balanced and that rate cuts would be appropriate next month if this trend continues. Hollenhorst expects Powell to confirm the market's pricing for a return to rate cuts in September. But he does not anticipate that Powell will explicitly commit to a cut at that meeting. While he does not expect Powell to comment on the magnitude of the cut, it is reasonable to assume that the base case at this moment is for a 25 basis point reduction.